everyone for coming tonight. So I'm actually really excited about the presentation we have tonight. As we went through, getting this ready, all of us, we were actually shocked, I think, at some of the data we saw. Like we knew by experience what we were going to cover, but to actually see it in data was really interesting. So we'll talk about, should you invest in Calgary condos? The key word here is investing in Calgary, right? We're not really covering condos for homeowners, mostly for investors. So I'll hand it off to Santhosh, and he's going to cover some market update for us.
All right, so starting off with a market update. So in this slide, we have the total residential price, which is across all property types. You can see our sales have dropped year over year. Months of inventory are trending upwards. They're actually up 81% compared to the same time last year. Average days on market are going up. Our year-over-year sales price has gone up as well, as we all expect, right? Now we'll go into the different categories. So we have the freehold properties here. So you have your detached and semi-detached. And you can see the months of inventory are going up 2.46, 2.08 for the semi-detached. So still still a seller's market in both property types. Although with the increasing inventory, it is giving buyers a bit of an edge when it comes to negotiating, and some properties are also experiencing price drops. And some of this could be attributed to seasonality. We're heading into a winter market. Kids are all back to school. The market tends to slow down, but this wasn't the case for the last 2 years. So this might be an indication that we're heading to a more seasonal market. Now, we're looking at the condo type properties, the row houses and your apartment style properties. Still a very strong seller's market in the townhouse segment, although look at the increase year over year, over 100% increase in inventory. So if you were in the market for a townhouse last year, you'd have realized how crazy it was. Things are still pretty crazy there, but a bit better. But here is the interesting information. Your year over year increase is it's 121%, right? And almost 3.2 months of inventory. And this went up super fast, right? And where do we see this headed? We think this is going to get a lot worse before things get better. Calgary is really good at building. So right now we have a ton of projects on the go. I think we're going to likely end up with an oversupply before all the supply gets absorbed.
Especially for the apartment space.
Exactly. So since we're talking about condos today, what are some of the benefits and why do you want to buy a condo? First of all, they have a cheaper price point compared to other property types, right? You can buy a condo, especially if you're going to occupy it as an owner-occupied unit, as little as 5% down. This is often popular, especially in more expensive markets, Toronto, Vancouver, where the price of a condo can be, upwards of $500,000. It's easier to manage from an investment perspective. Often with condos, you have a condo board, they handle snow removal, landscaping, your exterior windows and that sort of stuff. So it's relatively maintenance free, right? With an asterisk. Amenities, so if you're looking at a newer condo, you own something newer, often they have gyms, maybe a pool or a rooftop garden or something like that. So it can be nice, right? And lastly, condos might be in an area with more density or more retail, commercial, or in a more walkable area, right? For example, if you have a condo on 17th Ave, I think a lot of young people want to live there. So this slide, we're going to compare condo townhouses versus freehold townhouses. So the short answer is the freehold townhouses are better. However, older townhouses might be better off in a condo structure. Because often what ends up happening with the freehold townhouses, when the structure is newer, it's not an issue. But as the structure gets older, say 10, 15 years down the road, and you have a freehold townhouse, and you have 10 units in your building, and you got to change the roof because the roof is at the end of the lifespan. If there's no management in place, then there's no accountability, and one person might change the roof, your other neighbor might not have money to change the roof, so their roof is leaking, and it ends up compromising the whole structure, and the place just starts to look more and more run down over the years. Right?
Or you end up with one neighbor that's got a brand new fence, the next one's like all falling apart.
Exactly. So yeah, but you do get more flexibility with freehold townhomes, right? So you generally don't have to ask for condo board approval if you want to do a short-term rental or whatever. It'd be your decision. So both freehold and condo type townhouses are more desirable and resilient to fluctuations as opposed to something that's apartment style. Okay. So now on to what we don't like about condos. So you can see the list is longer, what we don't like than what we like. So let's start with the first one, limited appreciation potential. So Anthony's going to cover some stats later, but you'll see condos tend to experience price fluctuations a lot more than other property types. So especially in the case of market downturns, condos tend to fluctuate more in price. Limited control over property modifications. So that's the next point. So say you want to add a wall, you want to add a bedroom in your condo, assuming it's big enough. Or even if you want to add something as simple as adding AC, often you need condo board approval for those things, and there's no guarantee that they approve it. If you want to get a dog, if you want to get a cat, you often need approval for those as well. Okay? And you also have lack of flexibility to change your investing strategy in the case of market downturns, right? Say you're renting it out as a short-term rental and rents drop 10 to 15%, and now you're cash flow negative. If you had a freehold structure like a semi-detached or a detached, you can often change strategies. You could switch to a room rental model, right? You could do Airbnb. You could do student rentals. So there's options there. However, you can't use that same approach with condos, right? You have lack of control over the condo fees, which directly impact the resale value and how easily you can resell it. And lastly, you don't own the land. You just own a tiny fraction of the land. And the older the condo gets, the more it tends to depreciate in value as well. And the risk of of the complex needing major repairs tends to go up as well. So it's not a great situation to be in. The longer you keep a condo, the older it gets. I'll hand it off to Anthony now.
Yeah, so we'll talk a bit about the data behind what Santhosh has been talking about. First slide I have here is the Calgary benchmark price for single family, townhouse, and apartment condo since 2005. Why 2005? Just as far as we can go. I would love to go back further, but we don't have the stats. So you can see there's been a few cycles in Calgary, right? A few of you might be familiar with kind of 2005 to 2007 run up. There's a few things that are interesting here. First, this upcycle, you can see, even though the curves look similar, the single family one actually had a bigger increase than the condos did. And in this case, which we haven't seen last one, it dropped a little bit more, but that's about the only point in time where it's done that. If you look over here between 2015 to 2020, right, their last downturn, they may look similar at first, but they're actually not. Because if you look at the trajectory of that curve, which is a single family, it's fairly flat, right? It's fairly limited price drop. If you look at both townhouse and condos, they saw a bigger price drop. Now, there's actually more to this, and I'll cover it later. Can anyone guess what's missing in this chart? I won't tell you if you get it right, but I'm curious if anyone's thinking of it. Against the benchmark price over that timeline. No guess? Well, keep it in your head and we'll cover it after. Okay, so next slide I have Calgary benchmark price, or chart I should say. Calgary benchmark price peak to now. Why did I pick that? Well, if you bought at the very peak, which is tempting for a lot of people, right? You get a lot of demand happening around this time. Everything looks good. Appreciation's going up. So let's say you bought right at the peak in 2007, and you sold, or you look at the value, right, in August 2024. Benchmark price again. The apartment condo would have appreciated 28% in that time period. That's quite a long time, right? It's not a huge number. The row would have been almost double, right? 52%. And detached, 68%. So it's significant difference. But it's actually not everything. Because in that time period, there's been inflation as well. And CPI inflation, which a lot of people disagree is actually the inflation we're living, but assuming that CPI is actually the inflation that we're truthfully seeing, the apartment condos are actually lower than inflation. Now, that being said, yes, you were probably leveraged in that purchase. Your return on investment was probably higher than just the price increase, but that chart alone still is concerning, right? You wouldn't want to buy an investment that doesn't even outpace inflation. And that assumes everything went right? You had no special assessment, you had at least break-even cash flow, and that's the numbers you're looking at, right? Now, a lot of you will tell me, well, you bought at the peak, so what if you bought at a really good time? So I picked 2005, which is probably one of the best time you could have bought, at least in the last, call it 15, 20 years, right? Just before a huge run up in price. Condos were starting to be a bit more popular in Calgary as well. If you bought at that time, numbers look a lot better, right? Now you're beating inflation, but in that best case scenario, you timed the market well and everything went right, you still picked the worst performing type of property you could have bought in terms of appreciation, right? So best case scenario, you underperform compared to what you could have bought. Worst case scenario, you're not even beating inflation. Now, when I was saying that the that the benchmark price was missing something, is that as you go in time, the way the benchmark price is calculated, it looks at a typical property that someone would buy in the current market, right? At the current data point, which means if you look at 2005, it's not the same property as today. And as you build new properties, they keep being added into that benchmark price, including in the case of detached homes, homes are getting bigger, right? So that gets factored in the detached price. That's why I picked up this chart. This chart looks at condo, apartment and condo townhomes that were built between 1980 and 1990. Why did I do that? Well, we're looking at 2007 in this case to 2004, right? So that eliminates that idea, like I was saying, that new properties are being added into it. It's more a realistic scenario of if you bought a specific given property and you want to know how much that property appreciated over time, which is what we care about, right? We don't care about what the market is doing all that much. We care about what our property is doing, right? And if you look at this, in the case of an apartment style townhouse, apartment, I picked 800 square feet to 1,200 square feet just to kind of make it more average, right? And 2-bedroom. Between 2007 and today, almost the same, right? Now, if you bought at different price, like different time, you might have gotten some appreciation, right? If you bought in 2010 and sold now, you have had a bit of a better result, but still a very roller coaster curve, right? Lots of ups and downs, and significant up and down. I mean, if you bought here and sold here, you're not happy, right? If you bought here and sold there, you're not happy either. Townhouse, a little bit better, right? Not as much variations. And if you bought at the peak, you're getting a bit of a better result today, but still a fair amount of variations. Now, the next one is detached. And again, limited the square footage, so we're not adding those new, larger homes. This is more representative of buying a house in built in 1980 again and seeing what the land appreciation does. Very different chart, right? Even if you exclude the last few years, which were obviously very good, even if you look at this, okay, we had the downturn, prices were mostly flat. And then we had a bit of movement, right, from the last peak, but there's a lot less ups and downs. So if you bought here and sold here, your drop is not as big. If you bought here and sold here, you're not losing that much money. Where that chart, again, look at the difference of the direction of that curve, right? Here, it's significant. It's a big difference. And the thing is, everyone think they can time the market, but very few people actually do. Ourselves included. The market moves fast, and by the time that you see a movement, it's often too late, right? That's one of the reasons why we often recommend buy and hold and just hold long term, because it's hard to time those specific changes. But the second thing to that is you want to have an asset that's more resilient to those changes, so you don't have to time it as well. So I'll hand it off to Layne. He's going to talk a bit about kind of the forces behind the scene that are causing those things to happen. So there you go. Grab this.
Yeah, this data that Anthony looks up is actually very hard to find. So this is something that I've told people for years, but I never actually had this data to back it up. Benchmark prices are hard to find. Only a realtor can actually access certain aspects of it. But just to reiterate what Anthony was explaining about how he adjusted, instead of just using the benchmark, they're taking, so if you bought a 1980 property 20 years ago, that property would be 25 years old. But so now this compares it to a property that is now a 2000 property that's 25 years old. But your property is not going to get newer. Your property is still 1980 property. So when you compare the 1980 property, which is how Anthony pulled the data out here, is he actually took it's still a 1980 property that you bought. How did that actually perform? And that's where you actually see this really big difference, because our properties age. They don't go up with the average. So if you could buy, again, 25 years ago, if you bought a property that's a 1980 property, it's now 45 years old. So that's the data we really want. So that's what he pulled out, and that's what shows these, really big differences. So it doesn't show up here. And I think this is where it would show up the most, because the condo is getting very old and certainly run down. The actual structure on the condo is what's depreciating. And that's where I kind of, go into what I've always talked about, and why if you've heard me say anything about condos versus houses, you'll know I don't like condos as an investment. The land is the part of real estate that goes up in value. The building actually depreciates in value to the point where CRA agrees enough that they'll let you depreciate the value of your building. So when you file your taxes at the end of the year, even though the sale price would be higher, they'll still let you depreciate the value of the structure or the building that you have on there, because it's going down in value. So if you bought so that's why if you buy a house in Highland Park or Glendale or Acadia on an old like 650 grand right now, and you tear that down, it's probably still worth 650 grand, give or take. Otherwise, builders wouldn't be buying them and tearing them down right away, because there's another use for it, especially if you buy it in an older neighborhood on one of the 6,000 square foot lots where you've got a lot of land as a portion of what you're purchasing. So if you go buy a $400,000 condo, it really doesn't even matter what neighborhood, even worse if it's in a new neighborhood, but that condo, very little of what you're purchasing is actually land. So you have an undivided interest in the land, but if you go buy, whether it be a townhouse or an apartment condo, you might pay $400,000, but if you take that building down, your undivided share is going to be $40,000, $50,000. So very little of what you're actually buying is in land. Most of what you're buying is in a building that actually depreciates. Now, over time, that gets hidden into the inflation, and of course, the land value does increase. But you're buying more of a depreciating asset by comparison. So that's why, over the long term, a single-family house will outperform, and you'll do better over time with that, especially if you take into account the change of use. So if you bought a house in Highland Park 15 years ago, you can now tear that down and build infills on it, a fourplex on it, even up to an eightplex on those same lots now.
Well, even if you're doing multiple lots and you're getting something like
yeah, you could get either way. You could get more density out of an old lot because you bought a really big chunk of land. Now, some people say, well, why not just buy land? Well, because you still have to pay $650 for it, and then nobody's helping you buy it. So you can't leverage it to the same extent. But if it's got a house on it, you can borrow the money to purchase, or borrow most of the money to purchase it, and then have somebody else live there and actually pay for the cost of borrowing that money. In a condo, they kind of already touched on this. There's different objectives for different members of the condo boards, common areas, condo fees. There's a special assessment that comes up, restrictions on pets, that kind of thing. I'm going to skip that over because I really think Santhosh kind of covered most of those. This one is going to bore everybody, so I'll rip through it really quickly. But there's a really big point, is I've seen people trapped in condos. So I had the worst scenario I saw was 8 years. This was from somebody who called me with a live purchase that they had. So a realtor referred them, and they called me, and she said, I have I've got this live deal, trying to sell my condo. And I actually got her approved for it pending the sale of her condo. But her condo didn't sell, so she eventually just gave up on her purchase and just contacted me every 8 months, 6 months to update me on what was happening. And from the time she first had her first called me until the time she was able to sell was 8 years. So what happened is there was a building envelope issue. So a building envelope means typically the siding or the roof. It means that water is somehow able to get into the interior of the building and start causing mold and other issues. So when that happens, you need engineers report to come out, then you need, mold abatement to come out, deal with that. And then but then what happens is, because it's a condo, nobody's making the decisions. Everybody has to make the decision. But the condo boards meet, once a quarter or once a year for an annual general meeting. So everything moves at a snail's pace. Everyone argues about what should be done. And then it takes a couple of years to decide what to do. Then then the management company, puts the work out for tender, says, okay, here's the companies. 6 months later, they get it all back, and they have a report. Here's what it's going to, here's the 3 different quotes. Here's the cost. Here's who's going to do what to fix the siding, do the remediation and do the roof. And then you get arguments. Hopefully you've got someone actually complaining, saying, no, this is it's too high. These quotes are too high. But you often don't get that, because what happens if somebody comes to me and says, hey, I just got a couple of quotes on my roof. They're about $10,000 or $11,000, $12,000, somewhere in there. Is that reasonable for a roof? I'm going to say, yeah, that's about reasonable to replace some shingles. And if you got a big house, it might be $16,000. But if somebody comes to me and says, hey, I'm in a 60-unit condo building. I just saw the report from my management company saying that it's $280,000 to replace the roofs, or it's $510,000. I can't tell right away whether that makes sense or not. Nor can I can't even call a roofer, because the commercial roofing company is going to say, well, they can't just give you a ballpark and put caveats on it. They'd say, well, we have to go out on site and do that. But if you're not the person making the decisions, I'm not even going to bother doing that for you. So you end up overpaying, but people will catch that when the numbers get big enough, and then there's constant arguments back and forth. And a lot of people's like, I just want to sell, or I just don't want to pay anything. And everything takes forever. Then you finally get it. You can't sell during this time, because CMHC, Genworth, and most of the lenders by now know the building doesn't have an updated engineer's report, or the last one they have shows unresolved issues. So now nobody will finance the building. So even if you could find a buyer, they can't get a mortgage, so they have to pay cash. So unless they're going to pay 70 cents on the dollar, no one's going to pay cash for it. So then it starts messing with the values. So then the work finally gets agreed on. People decide what they're going to pay, and they either go with special assessments. So then the special assessments, or you could go with higher condo fees. So do you want $1,000 condo fees for a couple of years? Well, then it makes it hard for buyers, or it turns buyers off. Or you have special assessments to say everyone has to cough up $18,000. But what if they don't have it? And if they don't have it, then the lien goes on their title. And if they don't pay it, or they can't afford it, eventually what happens is they'll go into foreclosure. And then you have a bunch of foreclosures in the building. So, and those foreclosures, whoever has to buy it, it's a foreclosure, and then they can't get financing either. So all the values get suppressed, and that's what was happening in this lady's building. And then finally, once all the work is done, everything's good, lenders can lend again, then there's a stigma on the building, and it still takes a few years to get it all back to normal, to where she could get her value up to sell to pay off her mortgage. And that was an 8-year period for this lady stuck in a condo. So imagine if you bought your first investment as a condo, and then you had all your money tied up in it. So now that's a worst case scenario. That's a pretty bad case, but this happens often. It just usually doesn't take 8 years. This might take 3 years. The most important part is that you can't get out. Same thing happens if you own a single family house. You get a flood in the basement because your eaves trough overflowed. Go get someone to fix the eaves troughs, make a call. within a week, you could have someone fix the eaves troughs, make sure the grading's done properly, find someone to replace the floor, put it on your credit card, and then sell the house if you want to sell, or just deal with the issue and get it re-rented again. So this is now the comparing strategies. And the reason I bring this up is a lot of people will come to us and say, well, I know somebody, or my brother-in-law, or I purchased a condo back in 2005 in the dream case. I made a lot of money. Like, so I purchased a condo and it returned me this much. It's been a great rental property for me. And timing everything perfect, it did work out. It is a good cash flowing property for you now because you've got a $90,000 mortgage on what you could sell for $350 or $380 today. Of course, the numbers work. Or maybe somebody did it recently. This is the pre-sale condo, which we don't see as much in Calgary, but Toronto and Vancouver, and certainly in the times in the past. We have seen it 2007. We saw a lot of it here. People buying pre-sale condos. So you put your 5 or 10% down, and then you wait 4 or 5 years, and then you take possession. It's worth way more than you bought it for, and you've just made a bunch of money for doing nothing. And there were people who, yeah.
That's not a good strategy in Toronto right now.
Yeah, oh, absolutely. It's not a good strategy anytime, anywhere, because of exactly what's happening. So I'm sure some of the things you're referring to is, if you bought it like the peak of 2022, say March of 2022, one of these condos, there's a variety of things going wrong. So one of the things happening is, let's say you paid $800,000 for a condo. Now that condo might be worth $680,000. But you also have to pay, because so much money's been being made, the government was getting away with a bunch of levies and community art fees and all this stuff. So tack on another $60,000 you have to come up with out of pocket. But then on top of that, you have to put your 20% down, but then the bank says it's only worth $680,000. So you have to come up with that $120,000 difference plus 20% of the $680,000 value. So now you have to come up with double your down payment, but if you don't have it, you're still legally obligated. So it's not just that you lose your deposit, they could sue you for the rest, which they're now doing in Toronto. So you see condo development companies suing people for this. Now, had I told you not to do this in 2015, you'd hate me because you would have missed out on making a lot of money. But it's like telling you not to play Russian roulette for $10,000 a trigger pull and you made $10,000, right? It doesn't mean it's a good strategy because there are a lot of risks associated with it. And imagine that scenario if you'd done it 4 times, like you have 4 condos that you bought in 2022 or sometime around that period. So that's a lot of what we haven't seen unfold yet because the 2022 condo project started, won't be complete yet. So these are pending still. But so here's the same thing. You've got somebody telling you it was a great strategy. Go ahead.
Is it okay to ask questions?
Sure, yeah, absolutely.
Or should I wait?
Yeah, no, absolutely. Ask me now.
Okay, just something that you said, I just want to clarify. So if, say, the condo is now worth $680,000 and not $800,000, does that mean the bank is only going to lend you on what it's worth today versus
Correct.
what you agreed to pay?
Yeah, so the bank will say, we'll lend you, 80% or whatever percent of $680,000.
Okay, not
So,
the $800,000.
Yeah, so the 120 you have to come up with
Oh, wow, okay.
on top of the 20% down of the $680,000. And if you're, and that's what's happening to people. So that's, to the tune of an extra $100,000+ on all these condos in Toronto, you start compounding when all these finish. Now the problem is they can't rent these things and they can't sell them because nobody wants these little shoebox condos.
If you close on it, the builder can sue you.
Right.
Because they were expecting 800.
And that's the agreement, yeah.
Right.
So we'll start to see more of that happen as these cycles for the condos actually get fit, like as the building gets finished and nobody actually has the extra money. And then it's going to start impacting those 680 values and make them even worse. So yes, so good point. It is not a good strategy, which is our point too. So again, like in this scenario, if somebody bought it in 2020 for $380,000, took possession at $510,000, 23% return, and all they did is put their 10% deposit down. So it's a great strategy, right? But what you have to do is also compare it to 2 things. Number one, what would buying another, like compared to another strategy in the same market. So if you bought a single family house during that time period, you'd probably make a higher return, but also less risk. Plus, if you, again, bought in Highland Park or Glendale, then you've got builders knocking on your door wanting to pay you even more. So if you're buying a good property, keeping in mind that I want a good chunk of land, and the structure on it itself is just to help me finance the land that I'm purchasing, then it could be ripe for development down the road. And that's kind of a longer term game, but I really do think real estate is not a short term game at all. Everything I think was, 5 years would be the minimum I want to own something, and I treat almost everything as if I'm going to own it for 20 plus years. So yeah, getting caught. So the other thing is, if you buy one of those pre-sale condos, as we've already discussed, you might recognize that that's happening. You can't exit. You have to just watch it happen to you. So you're stuck at the mercy of the market, watching, going, well, I could eat a $50,000 loss. Now I just want to get out. If you buy a house or something that's an actual house that you take possession of right away, you could always turn around and sell it. If you're like, oh, the rents are going down, prices are going down, I could sell it. I can get out whole and live to fight another day. If you buy a pre-sale condo, you're stuck and there's nothing you can do about it. You can't get out of the contract. You just have to wait and watch the market go down around you. So you have no control over what your capacity. You've stopped your ability to maneuver for 4 years. Not to mention that can also impact your qualifying for anything else for 4 years, because you've got this pending deal you have to deal with on your financing. Basically, same thing we just covered. Yeah, we've pre-covered that now. Yeah, so this is where we talk that's 3-4 years of construction, 6 years from kind of the original concept and often pre-sales until the actual possession of the condos. We've seen it take longer than that too, but I'd say between 4 and 6 years is typically when the pre-sales start to when somebody gets possession. But that's where I was saying you're stuck in that roller coaster with no capacity to get out. So that's
sign it.
Well, you can if you can find somebody to do it, but most condo builders now will have a restriction of your ability to sell it, so they won't be involved, and sometimes they won't allow assignments.
Yeah, just to answer that, because we've gone through quite a few assignments recently, or at least people trying to do it. There's a few problems, right? First, you need to find, even if they let you assign it, you need to find someone to actually buy it. And if they know the value's gone down, now you need to come up with a difference, right? That's the first issue. Second issue, like Layne said, not all builders allow assignment, and it depends where you are in the purchase cycle. Some, if you're too close to closing, you won't allow it. And the last thing is, most of them prevent you from marketing it. So even though you can assign that condo, in the vast majority of cases, you can't do MLS listings, you can't do Facebook advertising, you can't put it on the internet. You're kind of stuck to either dealing with a group like us that has direct investor database, or just friends and family and big group friends. So
Yeah.
in practice, it's harder.
There's one more. You may not be alleviated of the responsibility to complete on that deal if you assign it.
That's correct.
Right, yeah,
Depending on
yeah.
how-
You have downward negative and no upward potential.
Yeah.
So you're even worse case by assigning it.
Yeah, because your assigner, like the person you assign it to, is then it's like, hey, if hopefully the market turns and I'll take possession and I'll have gotten a deal because you coughed up 60, 70 grand to make it happen. And if it goes up, he can just choose still to walk away. You could theoretically sue him, but either way, you're getting sued from the builder. Like, they don't alleviate that responsibility from you. And if they allow it, they definitely won't alleviate you of the responsibility. They'll come after whoever they can to get the money. So, I mean, one of the main points, as we've already touched on, land is the part of real estate that goes up. The building itself is a depreciating asset. So the higher percentage of land that makes up the value of what you're purchasing, the better long-term appreciation that you're going to get. And also, when deciding on a strategy, you can't just look at the specific return that you made or someone made in a previous transaction on that type of strategy. You have to compare it to the return of the general market. So if this has happened a lot in the last few years. You might even know someone. Hopefully you're not one. But if you've been flipping properties recently, You might have made I've seen people have bought a house in 2022 and just sold it and made a 15% return because they flipped it and made a high-end property out of a property. Well, if they would have done nothing, they would have made more return. So they think their strategy of flipping and turning an older house into a high-end property is making them money. But if they compare that to what the market did, they've actually, their work lost money. They should have just bought it, left it vacant, then sold it. They would have made 23% instead of 15%. And a lot of people, when I point this out to them, they just like, I'm not, it's hard for them to take, but it's like your work actually didn't do anything. I'm usually a little more gentle about how I show them, but I want to be I don't want my investor to, make money on one, then do another or do two at once, because I've seen this through two previous cycles. When 2007 to 2010 happened, a lot of people, there were people quitting their jobs flipping houses because the market was going so good. They'd buy a house, take 8 months to paint it, put new laminate flooring in, some new baseboards, and then they'd sell it for 120 grand more. So then they thought, they were just like, why would I have a job when I can make 100 grand times 3 or 4 a year? But then when the market hit, when the market stopped doing that, they realized that, hey, I upped my price 120 grand. Why is nobody buying? And I saw people go from being millionaires to bankrupt from actually just employing a strategy that worked, but it was actually the market doing the work, not them.
And it's possible to make money flipping, right? But the whole idea is to separate the market from the actual flipping, which is difficult to do. Right.
Yeah, it's not saying you shouldn't flip, although I usually say that, except we did flip a property that I would do again, even if if I had that opportunity. But very, very, very few times do people actually take into consideration the strategy that they're using and compare it to what the market's actually done versus what they've actually done. So if the market went up 10% and you made 20, okay, your strategy's working, but it's 10%. So make sure you're keeping that in mind. But often when people realize they're also 100% vacant, so all their costs build up. If you just bought a property as a rental, rented it out, your net worth would still be up, or you could sell and you'll have made a lot more money with a lot less effort and a lot less risk as well. And that's the other part of that is you also have to, so you can compare it to a different market, and then also compare it to a different strategy as well. I'll give this back to Anthony.
Yes, I'll cover up some examples. So we've talked about kind of the theory around it, data and whatnot, but I actually picked up a bunch of real life scenarios of how these things can play out. Someone I know that bought this as a homeowner property and then turned it into an investment a few years after. Purchased in 2010 for $335. It's worth about $335 today. So about the same price, but again, there was inflation in 14 years. It's significant. There was also special assessment over the years, and was also cash flow negative for most of the hold period. So not a great one. That one was downtown in Beltline.
Can you go back to that actually?
Yeah.
What are you see the condo fees at 724 there. That's the way the value, the value difference I'm talking about, the building depreciating in value, that's how it manifests itself in real life. So the value, can kind of go up with inflation and everything else, but the way the actual depreciating, the building as it's getting older, the way it shows up in the numbers is actually an ever-increasing condo fees, like 724.
And to Layne's point, this condo, if I recall correctly, was around $500 a month in 2010, right? So there's been an increase in condo fees. Now, it's not an extreme example. Toward the end, we have some other example that show that in action. But to Layne's point, sometimes we'll see fees go from 300 to 600 in just a few years span. The problem with that is now the payments required to buy that condo, even if the price didn't change, go up significantly. So the value of it essentially goes down conversely, right? So
and that's where that shows up in that benchmark. It doesn't show up properly because it's not comparing the condo aging. It's comparing a 20-year-old condo to a 20-year-old, 20 years ago to a 20-year-old today, instead of a 40-year-old today, which if you bought a condo would now be 40 years old, not 20. And that's where you actually see that number show up. So it's hard to show it. You can't see it in the typical benchmark data.
Yeah, exactly. But there you go.
Okay, so yeah, what if we looked at a brand new build, right? We're talking about 20-year-old buildings. Okay, what if maybe a new build performs better? So this is a current builder, won't name who the builder is, but they've got some projects, brand new builds, one bed at this price, starting from here, and starting from here for various layouts and sizes, right? Keep in mind starting from, right? So on top of that, you often have upgrades plus GST, lot fee, blah, blah, blah. But this is the phase before their current phase that they're advertising. Very similar units. See, this is a brand new build, 543 square feet, one bed, one bath. The same thing on the resale market. So these are from the last 90 days, sold for $277. So it's already less than the cost of a brand new unit, right? Same thing with the 2-bedroom layouts. You might think 2 bedrooms, easier to sell, tend to be a bit more resilient. Same story here. This sold, a little bit over their starting from price. But if you factor in real estate commissions, lawyer fees, your holding costs in that period, you're still net negative, okay? You have your estimated net proceeds at the bottom here. So they're walking away with this amount roughly. So still doesn't work out to be a great investment, even if you consider buying something brand new, okay? Now, what about another pre-construction property? And how about if we look at something that's a bit more inner city, right? Maybe you might be thinking, okay, I buy closer to downtown, might hold its value a bit better. So this is a 474 square feet, 1-bedroom in Bridgeland. Fairly popular building, at least to us, for the wrong reason.
Not our investors, but people coming after the fact that bought the construction.
Yeah. Unfortunately, we've spoken to a few owners from this building wanting to offload their units. Unfortunately, they're not able to sell it for not even close to what they bought it for. And they often, a lot of these owners actually put their deposit down in 2016 or 17. Yeah. Yes. So many years ago at this point.
At a time where the condo market was a lot cheaper, right?
Yeah.
So they had the market appreciate like crazy in the last few years.
Yeah.
And they're still losing money after all that time.
Exactly. So this example, they paid $315 in 2019 for one of the units. It's worth around $265 today. So worth around that. So really after your cost to sell and everything, you're more around the $240 mark, right? So it's a huge loss for this person.
And now they're pre-constructions, right? So if they can't close on it, it's the whole scenario Layne was mentioning
Exactly.
earlier. Because now the bank's not going to give them $315 anymore.
And if you can't close, then you open up a whole other bunch of issues. You end up opening yourself up to being sued as well. So, okay.
Can you cover the condo fee on the previous one?
Oh yeah. So condo fees, yeah. 176 at purchase. This is when they took possession. Now the condo fees are up to 292, which isn't terrible, but more realistically, these condo fees are set to go up. Often we see with new builds, the condo fees are artificially low just to get the units sold. And typically around the 3 to 4 year mark, the condo fees go back up to where they should be. And the management company often tries to cover the shortfall that existed in the first few years of the building.
Again, this is a brand new condo.
How much would this rent for? What would be rent?
This 1-bedroom, 474 square feet, it's really a shoebox condo. It's not popular among local Calgarians.
What would be rate? Give me dollar value.
This would probably rent for 15 to 16 at best.
15 or 1600?
Yeah.
If you have nice view, it might be like 18.
Yeah. On top of that, you have condo fees and all those expenses, right, to factor in. So.
Yeah, and for the condo fee, one thing I wanted to add is this is a brand new condo, and as far as I know, has nothing wrong with it. Right?
Yeah.
It's not like the fee went up because there was some special assessment or reserve fund shortfall or anything like that. It was purely the developer set a fee to attract buyers in the pre-construction phase, and it's just not high enough to actually cover your reserve fund replenishment and all that, and then closing it goes up.
Yeah. Okay, so next example, what if we buy in a more premium area, right? What if we look at Hillhurst, trendy area, cool spot, 2-bedroom, larger unit, 818 square feet. This one's actually a penthouse unit, and it's a corner unit as well. This person paid $750 plus GST for the unit in 2022. They bought directly from the builder, and they tried selling this property with a different realtor for 208 days on the market. Couldn't sell. And then they called us after the listing was terminated, and they say, hey, property's not selling. Can you take a look? What's wrong with it? And we said, your property's worth $650. That's why it's not selling if you're trying to get what you paid for it. They rented it out for $3,000 a month, so it's tenant occupied right now. Even with $3,000 a month, they're cash flow negative on the property. And is the property going to appreciate enough to at least back to what they paid for it? Who knows? It might take a while. But until then, really, they're just going to have to either eat the negative cash flow or take the big loss, right? So and condo fees are $452, which are likely to go up as well, considering this is a more premium building with some amenities as well. So, okay. Just a couple of other examples. So this is Lower Mount Royal, also a really nice neighborhood. Older building. This particular building's from the 90s, right? Decent size, 816 square feet, pretty typical size. Purchased for low 300s in 2007, $312 condo fees, and sold for pitiful $207,000 in 2023 with really high condo fees of $706. And it's not like this building has any fancy amenities like a pool or gym room or anything like that. So if you look at it in that lens, it's not great.
Excuse me, can I know when you use these numbers, do you the condition how the property was purchased and the condition how it's sold is the same or has a renovation?
In this case, it was in a similar condition, right? Because showing something that's been renovated, we would have to account for the renovation costs.
Exactly.
Right? Let's say they purchased it for $325 and put $50,000 into it, and they sold it instead for $270.
In about the same
I mean,
condition
they
as
would
original.
have spent money as well, right?
Yeah, I try to pick units that are similar, right? That from the time they bought it in similar condition. Okay, so another example, older neighborhood, Southwood. So this one's from the 70s, one bedroom, bought for $215,000, sold for $130,000. Condo fees didn't go up too much, but just the building.
Still almost 50%.
Yeah, still almost 50%, but in the grand scheme of things, it's not terrible. But the price really took a hit on this building, right? Just shows to go you some examples of how things can go wrong. So just to sum it up, are all condos bad? I'll let you make that decision. But if you're planning on buying one, make sure you have an exit strategy in mind and understand that things can go either way. You might get lucky, and when at the time you want to sell, the price might be what you're expecting, or the price might not be what you're expecting. You might have to wait it out, right? But also, you always hear, "Oh, I bought a condo. I bought a condo 5 years ago, and I cash flow like crazy." Right? That's true, but every property will cash flow with enough of a down payment, even in today's market. If I put 40% down on a condo, I'll probably cash flow.
Or if you have enough built-in equity in the condo, same thing. Right?
But is it getting you a return that's better or worse than other property types when you benchmark it? Okay. Especially if you're buying or considering buying an older condo, make sure you do extra due diligence, make sure there's no deferred maintenance on these buildings or any impending special assessments. So I want to say never skip a condo document review. So it's one of the conditions when you buy a condo, just like your financing inspection, never skip that, especially for older condos, because you want to make sure that there's enough money in the reserve fund.
Are there people that specialize in doing that kind of work?
Yes.
Yeah, so there are dedicated companies that do condo doc reviews, and they're really long documents, so they'll kind of go through that.
We still advise you go through it with the reviewer and with your realtor. The condo doc reviewer will mostly point out like the things to look for, but you still want to have a look at what their comments are and what the issues are.
So they don't come out and look at the building itself, but based on the condo doc reviews, they know all the upgrades that have been done over the years, right? They'll have all the annual general meetings and the
engineering report that has to, so an engineering firm has to come out to do effectively a home inspection every 5 years. And it's a reserve fund study and it ensures that the reserve fund has enough money for all the future maintenance that are going to come to basically take place over the next 20 years. They've basically got by the time the roof is replaced, they're already saving for the next time the roof needs to be replaced. So that all has to be built into the reserve fund study.
Yeah.
Should be.
Or it should be, yes.
That's the key word.
Yeah.
But if it's not, it'll get flagged by lenders or CMHC. But of course, there's a lot of variance in how well they do at it for sure.
Yeah, I think that's all. So, if you guys have any questions, we're happy to answer them now. So,
And keep in mind, we are also, as Anthony specified, these refer more to investments. If you like condos for a lifestyle, then be conscious of all these things while you make your decision.
Yeah.
But if you want to live downtown, good luck buying a house downtown. But I do know people who own a condo or even rent condos downtown and then own 3 or 4 single-family houses because they're better investments, but they still own a condo to live in.
Hi, so I read last week that the Competition Bureau is investigating the Canadian Real Estate Association over commission rates. How do you see that evolve over the next year, knowing that the Department of Justice and the NAR last year, they were buying heavily, they had a lot of new changes in the Parks Commission?
Yeah, it's funny because this morning, well, actually, Santhosh wasn't there, but I was just on a webinar with the CEO of eXp Realty, where our broker is eXp Realty. And he was talking a little bit about that, but it's still very speculative at this point. There's nothing that's like super set in stone. Short story, it sounds like this change is coming to Canada as well, but we'll have to see. Yeah.
So the changes are coming to Canada, you think?
Sounds like it's, who knows, right? The way that it's structured is a little different in Canada than the US, right? Because we have buyer representation agreement. My understanding is not everyone in the US was using that. So it's already a little bit more structured the way we are here. But we'll have to see, right? I'd be speculating essentially and just making guesses at this point.
Is this the difference? Is this the one that's talking about the listing is no longer
the cooperating
required
commission.
to cover?
Yeah.
Okay.
Yeah. Future will tell.
Yep.
So there's three other points that I'd like to add to your presentation. 3 other points of risk. First one, multi-unit damage from pest, fire, or flood. If you have a flood on 9th floor, it can trickle down all the way to the 5th floor, damaging 4 units, all in one lousy leak. Risk.
Very true.
Additional risk.
Yeah.
Yeah,
Second
somebody's
additional
fridge line.
risk.
Yeah.
Second additional risk that's tied to that is insurance rates. Because now you have 4 units you got to repair. Next year, or 3 years down the road, when you're renewing your strata or condo insurance, it's gone up. Furthermore,
Yeah, because don't forget the condo fees cover the insurance, and it's actually a fairly significant portion of the condo fee.
So when you renew your insurance, your condo fee goes up because your insurance rate has gone up because you had to take advantage of the insurance to repair 4 units because of the multiple unit damages too. And the third is when you're doing your rentals, you need condo board approval on certain types of rentals, and they restrict you on certain types of materials that you're going to use. So,
yeah, and to your point, Peter, to even add to that,
certain things, you're removing walls. Like you gotta be careful because you might get penalized, or all of a sudden you got expensive engineers that you need to do removals, low bearings, and what have you.
yeah, those are very good points. Yeah. And to add to that, if you have tenants, some condo boards will charge you when the tenants are moving out, right? Moving fees, or when they move in, or when security is needed, or when they need the elevator to move stuff in. There's a lot of extra fees that can go into it for sure. There's a lot of restrictions, right? We talked about control. You can do Airbnb today and your condo board allows that, but there's nothing that says in 5 years they will, right? There's only so much you can do other than being on the board and complain about it, so.
I just want to add that the condo fees and the special assessments can kind of go hand in hand. If you have low condo fees, likely you're going to have lots of special
100%. A lot of people get attracted to low condo fees, right? But low condo fees is not always a good thing. If your condo fee is so low, you can't even build up a reserve fund. What happens when there's an issue? You don't have money, and then you need to have a special assessment. right? So
Special assessments are almost the norm rather than an exception. So.
yeah, and I should mention, I'm not sure if everyone knows this, but you can't really get your way out of a special assessment, because when you sell a property, the property taxes and the condo fees, if it's special assessment or anything due to the condos, get paid before you get paid, right? So unless you're like crazy upside down in your property, they will get the money in.
Yeah.
You'll get whatever's left.
Right. Yeah, we sold a condo, and because the special assessment had already been announced, we had to pay the special assessment.
Yeah.
Yeah,
exactly.
Yeah.
And it often ends, your property value starts to take a hit at that point as well, because now everyone realizes, and it has to be disclosed that you have a special assessment, right? So,
And as an investor, like because of price fluctuations, what you were saying, if prices goes down, especially for pre-construction homes, what can we do? Are there any banks or companies who can do a firm approval on an application?
To do what, sorry?
Like for example, if I buy a pre-construction house for 700,000 today, and at that time I'm taking the possession is 600,000.
Yeah.
Right? Can I do something? Can I get a firm approval from a company at the time when I'm actually writing that contract?
Well, no, because they will do an appraisal, right? So yes, you will get a loan likely, but it's not going to be for the value that you purchased it. It will be for the value of the appraisal at that time, right?
So there is some lenders that are lenders, or even like the insurers will give a little bit longer timeline before they'll say, okay, we'll approve you for this long for this amount, so that you don't like 8 months or something like that. So there is some that will give pre-approvals, and it's possible even now, because what's about to happen in Toronto, along with the doubling of everyone's interest rates in the GTA, it's going to crush their economy. They can't have multiple units going into foreclosure. 50% of every sale that happened over a 2-year time period start to go into foreclosure. So they may start, CMHC may start saying, okay, well, we'll start honoring, if you guys buy these, we'll honor these for longer term. So it's possible, but yeah, you should not count on anything but risk associated with the potential drop. And most lenders
not the same as well. Like there is a lender, like one of my friends was telling me that who does firm approvals, even if the value goes down or something changes in your income or something, they stand their approval.
Well, for a certain amount of time, right? But if you're 5-6
or
years
if you're
out,
doing like a CMHC approval, like the insurer is kind of an automated system, they don't necessarily come back at you, but the banks are a little bit different. If it's CMHC insured, they don't care what the value is. They're not going to lose a penny. They do,
but you wouldn't use CMHC as an investor on a pre-construction likely unless you're going to live in it, right?
Yes. So that's you can't even get multiple.
And even if you could get that loan, is it a great situation to be in? Not really, right? Because even if you get 80% of 700,000 and now it's worth 600, you're still upside down, right? So if you have to sell, you still have to provide that extra money, right? So either way, it's a bad situation to be in.
It would reduce the risk of getting sued, right? You could just take it, suck it up for however long it takes to sell. So it's usually mitigating risk. But again, only buying a principal residence, you're going to get that kind of longer term guarantee with a CMHC approval. And you can opt, like even if you're putting 20% down, you could opt to get CMHC insurance, which will get you a slightly better rate. And just pay for the premium. So it is possible to actually do it that way.
And just on that point, because I often hear people that are losing money if they sell the condos say, well, I'm going to wait until the value goes back up. I just want to quickly cover that, because there's a bit of a misconception that if you're losing money today and you wait another 5 years and then you break even, you didn't lose money, which is completely false. Because if you sold today and lost 100 grand, put your money elsewhere, got a return for those 5 years, you're often kind of in the same situation, and often better, because if that other property has a better cash flow, for example, you're just delaying the problem even longer, right? So I just wanted to cover that. It's the price you pay, the price you sell matters, but you have to think of the opportunity cost of not doing anything and getting stuck. Assuming you have the funds to actually sell, right? That's the other problem. But
It's a really good point. Often, like a stock board was well, don't panic and sell. You haven't lost money until you sell, but you could, and that means if there's a panic, don't go sell everything, right? That's the stupidest thing you could do in especially in a very volatile market like the stock market. But when it comes to real estate, that's very important. People think, well, I'll just hang on. I don't want to take a loss. It's like you already took the loss because the value is already gone. So now you're just Now you're just choosing between having this as an investment or a better investment, and you're choosing the bad one. So it's definitely worth considering. And it's funny as we preach all this stuff, we get caught in it too. Like we often don't reassess our own properties. Like, well, wait a second, is this actually a good property? Like we just get caught doing our normal thing. And I think it was when we did the presentation on reassessing, like, should you keep your property? And started doing it. It's like, wait, I haven't done this in my own property in a long time. So
I think we'll close it off.
Yeah.
One more.
Yeah.
One more.
The last 16 months,
Yeah.
we have doing a lot of flipping. We're flipping townhouses, condos. We make a very good analysis of the property.
Mhm.
We renovate it, we sell it, getting about 30% annual profit on that.
Okay.
So, what you have to do is do a very good analysis, understand what do you have to renovate, and then you sell it.
Yeah, but also make sure, and we can help with that, but make sure you account for market, right?
Make sure what?
Make sure you account for market, right? Because for example, if you did 30% profit, right, on that property, but market went up by 20, you only did 10, right? The market did the other 20.
Okay, we're direct.
I'm giving an example, right? You really, I can't stress this enough, but really make sure you do look at that. And yes, you can make money flipping. Like we did a flip ourselves and we made really good money. I've done flips, another flip before. You can make money, but the people that get caught is when they don't consider the market. Even if you make good money, you have to consider how much the market actually helped you, because when the market flattens or turns around, that's when people get burned. And we've seen it over and over, right? People make good money when the market goes up. Then it changes, and because the flip wasn't actually making enough of a profit margin, now the market is not saving them anymore, right? So, and maybe you're still fine, right?
Yeah.
Maybe the market helped you only by 10% and you got 20% from the actual flip. But make sure you calculate that.
We're driving the market. So all the property that we have sold has been recorded in that areas.
Going price, yeah.
Yeah. So we're driving. That's it.
Yeah.
I don't know if we have been lucky, but you know what? We have 6 already in 1 year
Yeah.
from February
Last year.
2023, and it's been great for us. And
Yeah.
we're showing totally different.
well, we're not necessarily doing it.
We're-
We can still make
we're
money
talking-
doing it. We just what we want to is that the market. So had you bought some of those same properties and done nothing with them, the market may have returned 15%. So your 30 is actually only 15.
Potentially, right? Just an
Right, yeah.
example.
But having said that, in terms of purchasing power, you also have to pay tax on the whole thing, right? The capital gain and everything else. So you just have to take all that into consideration. I'm not saying you shouldn't do it, because 30% is a pretty good return. So, and the market, I don't think has been 50, maybe it's 10. So that means you're actually making 20% above the market right now, which is still a good living. Like there's nothing wrong with that, especially if you do lots of little small ones. Those are in some ways less profit margin, but way safer, because you're in and out really quickly, right? So you don't take the risk of the market turning, because you're flipping them so quickly. If the market turns and starts to go down, you're taking a month of that. You're not taking 2 years of it. Try to add a second addition onto a house or something.
You just want to make sure you look at the data, essentially.
We are now thinking if you do single home houses, doing a house will take you 2 years. And maybe we can make 30% of that development.
Well, something I really want to stress about what we talked about too is we talked about buy and hold, right? None of what we showed really applies to flips, because we're talking about longer term hold period, right? Regardless if you buy a detached house, a condo, an apartment, if you're in it for shorter term, you don't have the same kind of
Risk
Market risk.
exposure.
market risk, right? So it doesn't really apply. The other thing I really want to stress out is there's a bunch of people here that I'm sure can show me a bunch of examples where they made money buying a condo, and it's 100% true. The last few years have been atypical for Calgary in the condo market. So if you bought in 2021 and you're selling today, in most cases, you're making money. Now, again, we showed cases where people still manage to lose money, even with the market appreciation, but in most cases, you're making money, right? But that doesn't mean it's a good investment, right? because you can't always keep timing the market, right?
That was my point. I don't know if I should invest in a single home house for 2 years or keep doing.
In our general opinion, if you're buying,
I'm making the same amount of money.
Yeah, I would say
Depends on the strategy.
you should, yeah, it depends on your strategy. So you're referring to, like, my answer to that would be like now granted, I'll say that, like, if you guys are house flipping for a living, you're doing good at it, then you should keep doing it. But in terms of investing in a single family house for 2 years, no, you should actually just buy a single family house and keep it forever, or 20 years. Like, that's the idea. Number one, you can refinance, pull all your equity out, keep using it, and you don't have to pay
any tax on it.
tax
Yeah.
free. Yeah.
or sorry, any taxes. That's earned income. You're paying full rate. You're paying 40% tax rate. If you're flipping, it used to be 50% tax rate. Now it's 60 something, but that's probably likely to change back relatively soon. But still, you actually don't pay anything until you sell it. So you keep using the government's money over and over and over to continue to make more and more money until you eventually sell it. You have the capital gains associated with that. But instead of paying full freight, like full tax is not just capital gains, but you have to pay it every time. So at the end of this year, you're going to have a big earned income bill, which you wouldn't have had you been buying, say, rental properties. The difference is you don't get all your money back right away. But after 3 or 4 years of a buy and hold strategy, you'll have all your money back. You won't have paid any taxes on it, and then you can kind of accelerate from 2 properties to 4 to 6, to 8 to 15 properties, and it's a lot easier than like when you're flipping and selling. Again, you could do a combination of both as well, and also qualifying becomes more challenging. But that's more of we do have another seminar on that, and we can certainly talk to you about whether you guys want to consider buying and holding versus flipping as a potential strategy heading into the the next few years.
Yeah, that's amazing.
Well, thanks everyone
Yeah.
for coming today.